For generations, Indian families have passed down gold with absolute confidence. We view it as a cultural cornerstone and an infallible financial safety net. But that expectation collides with reality. At the counter, this transaction carries a heavy promise. The generational belief is simple. If you buy physical gold today, you are locking in continuous, unquestioned wealth for tomorrow. At a massive scale, people lock away vast fortunes in these bars, trusting the metal to act as a passive wealth generator that will only ever climb in value. The question is whether this deep emotional attachment is blinding us to how the asset actually behaves. When we examine the raw financial data, the numbers tell a contradictory story. This chart contrasts our smooth, upward expectation of gold with its jagged reality. The price of gold fluctuates heavily. It does not move in a straight line. This historical record of the 1869 Black Friday crash shows massive price drops. Severe volatility and sudden crashes in gold prices have been a factual reality for over a century. Treating gold as a guaranteed ticket to rapid, uninterrupted wealth misinterprets what the asset actually is. To understand investments, we have to treat them like employees hired to do specific jobs in a portfolio. Looking at this long-term time series chart of gold prices, we see entirely flat periods. These 5 to 10-year valleys of zero or negative growth typically occur during times of global economic prosperity. While gold flatlines, other assets take off. Expecting massive growth from gold during prosperous periods is like hiring a security guard to hit sales quotas. Notice the exact moments when gold prices actually spike. They correlate directly with global crises, market crashes, and panic. Gold's true financial purpose is not aggressive wealth creation. It acts as a defensive shield during worst-case scenarios. In personal finance, crisis defense means protecting your purchasing power when paper money fails. We call this an inflation hedge. Gold retains its inherent value while the cost of everyday goods skyrockets. As the value of currency drops, the relative weight and value of physical gold holds steady, keeping your wealth in equilibrium. But because it is primarily a defensive hedge, it typically only delivers those massive returns when the rest of the economy is actively failing. Recognizing gold as a defensive shield rather than a growth engine changes how much of it we should actually hold in our savings. If gold is just the shield, what does a fully functional financial portfolio look like? A healthy strategy requires diversification. You need different tools hired for different jobs, all working simultaneously. This diverse ecosystem has distinct paths representing growth, stability, and defense. They fluctuate independently but weave into a single, stable beam. When growth assets dip, the defensive gold asset rises. This balances the total value of your savings. You don't need to abandon gold entirely. You simply need to resize its role so it fits into a larger, diversified strategy. Think of gold as the airbag in your financial car. It is critical for your safety, but the car cannot run on an airbag alone. If you shouldn't put all your money in gold, where exactly does the growth portion of your savings go? In the next episode, we look under the hood of mutual funds to track where that money goes and discover who is actually managing it.
लाइक शेयर सब्सक्राइब कर दो यार।